Some people talk as if there's a conflict between monetary and fiscal policy, but actually they are mutually reinforcing. So when there's an economic downturn, for whatever reason, we can get into potential reasons later, the idea is that you could either reduce interest rates, so use monetary policy to increase business borrowing, increase the amount of money the private sector is borrowing and then spending to stimulate demand, to stimulate the economy. Or you could use fiscal stimulus, the state spending money to improve the economic situation. I've drawn these two bars, and let's say the white, empty one are all the businesses that won't respond to monetary policy. They don't want to borrow. And so no matter how much you reduce the cost of borrowing, the interest on borrowing, they're not going to borrow. And the striped bar represents all the businesses that would be responsive to interest rate reductions. So in such a scenario, since there's a big part of the business sector that would respond to reduced interest rates, then someone could say that monetary policy would be sufficient to reverse the downturn. Obviously, monetary policy and fiscal policy could both be stimulating, but because there's a prejudice against government intervention, then plenty of people would say the monetary policy, reduced interest rates is enough. But what about here? Let's say that taking monetary policy as far as it can go, reducing interest rates to zero, would only cause this little section of businesses to borrow more money, to spend more, but it wouldn't have any effect on the vast majority. This is the situation in which many people would say this is when you have to start doing fiscal policy, because the monetary policy just isn't going to work anymore. But this idea that there's simply some businesses that do respond to monetary policy and some that don't is simplifying things too much. If you consider on one hand the demand, whether that's existing demand from the private sector or additional demand made through government fiscal stimulus on one hand, and on the other hand, the effect of interest rates on businesses to increase borrowing, to increase their own spending, and thus adding new demand to the economy, these two things are mutually reinforcing in both directions. What's the reason why some businesses don't want to borrow money? Because they don't think they can make any profits with that. These businesses don't think that in the current situation, with the current demand for their products, for example, borrowing money to make an investment to expand their production would be profitable. So they don't do it. But what happens if these businesses here do borrow money and spend it? Then they're increasing the demand for the goods of the rest of the economy, which includes these businesses. And if these businesses see an increase of their sales, an increase in demand for their products, what are they going to do? They're going to be more willing to borrow money, to invest, to meet that increasing demand. And so more of them are going to become responsive to monetary policy. So saying something like only 40% of businesses would be responsive to a change in monetary policy or a reduction in interest rates and 70% wouldn't be, as a description of what would be the end result of, for example, a reduction in interest rates, is false, because the very fact that this 40% is maybe in the first instance responsive will create new aggregate demand in the economy to make some of that 70% responsive. And then them borrowing does the same thing. But this requires thinking in terms of dynamics, that things can have feedback effects on each other. Now, it's true that there is some sort of situation in which monetary policy alone is ineffective. And let's say this extreme situation here is that case, where monetary policy is completely ineffective. To say it's ineffective because there's no businesses in the camp that are responsive to monetary policy is kind of missing the point. The reason why no businesses are responsive to monetary policy is because there's not sufficient aggregate demand to encourage them to borrow, to encourage them to invest. And so the question sort of that's often debated, whether in such a situation monetary policy will help or fiscal policy will help, is putting two things at odds with each other which aren't at odds with each other. If the state spends money, creates demand in the economy, which is necessary for a recovery, the level of interest rates, the restrictiveness of the monetary policy, still matters in determining what effect this will have. This demand may fundamentally make a lot more businesses willing to invest because there's demand that if they can expand their production and meet it, they can make profits off that. But of course, profits have to be measured against a cost, and the cost of borrowing money is the interest rate. So the higher, the more restrictive interest rates are in such a situation matters. The higher they are, the fewer of these companies will become willing borrowers to further add demand to the economy and create a greater upwards trend. So in such a situation, monetary policy matters as well. Interest rates should be zero. And the looser monetary policy is, the better effect stimulus will have, fiscal stimulus will have. The lack of understanding of this dynamic can lead to some strange thinking. Let's imagine there's a country's economy with a nice growth trend like this. Then there's a stagnation, recession, and maybe further stagnation. So this shows the GDP. Some people think that in such a situation, the state should step in to fill in this gap in spending, to spend that part of the GDP level reached that's not being spent anymore, to maintain the economy at an equilibrium. So this is the fiscal stimulus of the government, and eventually, for whatever reasons of their own, the private sector will sort themselves out and recover, and the state just has to fill that gap until they do, to prevent things getting worse. Because if the state didn't fill that gap from this dynamic here, we can understand that things could go in reverse. The drop in demand means, for example, that businesses that were about to invest cancel their investment plans, cancel their orders, fire workers, so that money that would have been spent isn't spent, and things decline a little more. And then those workers without money to spend are not buying consumer goods from other companies, who then cancel their own investment plans, their own orders, and fire their own workers, which further drops the demand in the economy. And this is exactly how you get from this situation to this situation. Because of the falling demand, fewer and fewer businesses fall into that group that, at least in their sector, in their industry, or because of one company within an industry's particular competitiveness, that they're still facing enough demand to encourage them to borrow. But at the same time, the factor that this group still exists, are borrowing and spending, is exercising a counteracting force against the downturn by creating demand for the goods of this other group. The interest rate had been fixed and there was no monetary policy response. Then we could imagine that if there had been a response to reduce it, for example, to zero straight away, the downward trend might not have been so strong. The companies finding themselves in this group that are still willing to invest because of the lower borrowing costs might have been greater at every moment in time. Maybe not enough to defeat the ultimate downward trend, but maybe also, if the downturn wasn't from such a strong initial cause and the monetary policy was immediately reduced to zero, it's possible this increased demand from monetary policy alone would be enough to stop the downturn. But in any case, it would soften the downturn. And just as monetary policy can maximize the multiplying effect of demand, that is, with lower borrowing costs, more businesses find it profitable to react to supply the demand they're facing by increasing production versus those who don't find that profitable. The same would happen with fiscal response, with fiscal stimulus from the government. You could have a situation where, because fiscal stimulus was started immediately and the interest rate was dropped to zero, then the private sector itself responds to that increased demand by borrowing more, investing more, and creating the demand themselves, taking over that role from the state, or that need for the state to fill that gap. There isn't some independent behavior of the business sector, the private sector, that the state just needs to fill until that sorts itself out. They're dependent on each other. The state could even intervene to not just fill the gap at the previous GDP reached, but continue the growth trend. But again, the same simplification is problematic here, imagining that the private sector does their own thing independently and will eventually start investing and growing again. And until then, the state just has to fill that gap. But it doesn't work like that. The sooner and the greater within what's necessary for the specific situation, the fiscal stimulus is made, and the quicker the monetary policy is eased, this will affect business behavior as well. Business behavior being, do I borrow money or do I save money? Because I can't see any profitable way of reinvesting my profits. And in this case, the business behavior causes a quick recovery. And the government in the end has to apply less fiscal stimulus than otherwise. So there is no situation in which monetary policy works and one in which it doesn't. Or better said, there is no type of downturn or type of recession or different causes for a recession or a collapse, which would mean in one case monetary policy can have a positive effect and in one case not. It all has to do with timing, because as we've seen, the more demand is allowed to decline, the less effect a decrease in interest rates will have. So the longer is waited, the more things are going to end up in a situation where the monetary policy has no effect. But the question is, here at this point, is there some determining characteristic of the cause of the downturn which will mean monetary policy will or won't work? And the answer is no. If it's applied here, because it's multiplying this level of demand, it'll work a lot better than when it's first eased here. And often you hear the counter argument. Often I read something like, well, monetary policy didn't work, easing monetary policy didn't work, because in such a situation, the interest rate was lowered, didn't really have an effect, was lowered again, didn't really have an effect, was lowered again, didn't really have an effect. And this lowering is some percentage over time. But of course it's not going to have an effect, because putting it off and just doing a bit is meaning the positive effect you'll get is less. You're making the bigger the reduction, the bigger the multiplier will be. And the earlier that reduction's made, the more it will have to multiply the still existing demand. And so what you need is straight away the interest rates to drop from whatever level they are to zero. And why not? Because at this point, the productive capacity of the economy is at least enough to produce this level of goods and services, this level of GDP. So as soon as you're going under that, you want as much effect as possible to recover demand, because that demand's just going to be for the production capacity that's already there. It's not going to cause inflation or anything like that. And as soon as there are signs of inflation, then you can begin to carefully raise the interest rate. And as long as things continue to nicely recover, you can keep doing that. And you've got to think, because businesses are investing, taking a risk on what they believe future demand will be, and they're investing to be able to fulfill that capacity for a certain number of years, the actual capacity of the economy at this point is likely to be a lot higher, because businesses had been making investments on the presumption of continued growth. And so the actual demand gap, let's call it, the demand you want to recover, is much larger. And so you can risk dropping interest rates straight to zero and keeping it at that, keeping them low at zero, until you see actual signs of inflation, or until things are recovering, things are going as they were before. If things are starting to recover a bit, you don't then raise the interest rates, because then you just strangle off the growth again. And then you lower them a bit, and then you raise them a bit. No, you just wait till the recovery is complete. And one final point, often severe economic downturns, recessions, are preceded by a big boom, perhaps a speculative financial bubble. And so maybe if you're using the logic that I've used here, you say, well, as soon as things turn bad, that's when you drop interest rates to zero. But the answer is no. You drop interest rates to zero at the beginning of the boom, or when you see there's a boom happening, because it's too high interest rates that cause financial bubbles, not the other way around. It's not that interest rates are too low that cause people to speculate in financial markets. That's for another video, the details. But often, while a particular asset, for example, real estate, housing, may experience massive price inflation, there's huge amounts of unused capacity in the rest of the economy. And this is exactly why there's a financial bubble, because there's so many businesses finding themselves in this first group where they're making profits. Profits are savings unless they're reinvested or spent. But if a business isn't in the group of willing investors, it means instead of borrowing and combining borrowed money with their profits to invest, they've got to find somewhere else where they can make money with money, because there's no real investments to be made for which they can use their profits. So where are they going to put them? They're going to stick them in financial markets. And of course, as we've already seen, since the interest rate has an effect on how many businesses find themselves in one group versus another, the higher it is, the more restrictive it is, the more businesses will be making profits, but having nowhere else to put them, either than to buy financial assets themselves or lend the money to others who are very possibly, in the aggregate, in the whole economy, going to be spending that money also in financial markets, causing this bubble. So if you here early on lower the interest rates, maybe not to zero, definitely once the downturn has kicked in, you put them to zero, but beforehand, you moderate them drastically, it's very possible you could level this off, avoiding a financial bubble and the crash that would have happened afterwards. So to conclude, this video is not a pro-monetary policy video. The point is that they're not antagonists. They can positively reinforce each other or negatively reinforce each other. At the end of the day, you need demand in the economy. You need people willing to borrow. And if things have gotten so bad that the private sector doesn't want to borrow, then of course interest rates aren't going to do anything. But whether the question is about timing, about the fact that before the demand had diminished so much, or even after private sector demand had diminished so much and government fiscal stimulus had replaced it, in either case, the monetary policy, whether it's more restrictive or more easy, is going to have a negative or a positive effect on that demand, on it multiplying itself.